So what is the optimal time to invest? Suppose you have a significant amount of liquid assets right now. When do you step into the market?
Well, imagine that a good trusted friend calls you today and tells you that there's a tremendous investment opportunity for you. You can make between 6 to 10% per year guaranteed returns with no risk. The only but is that you have to put your money in for a minimum of 15 years. Plus, your assets can drop an average of 15.4% in the meantime. But if you hold your money for the long term, you are guaranteed to get your investment back plus 6 to 10% in returns this period. If you heard this from a friend, would you do this? Well, if you said no, then investing is probably not for you, because I just outlined to you a situation where you can make money without risk over the long term. If you would have said yes with your eyes closed, or you are still in doubt, then it is interesting to pay attention for a moment. After all, you can make this investment every day on the stock market. And how exactly this works, I'm going to explain to you in a moment. Because it is a fact that over the past 4 decades, you could have participated in the global economy's growth alongside the profits generated by companies worldwide. And this is simpler than ever at the push of a button. But many investors don't really understand how it works. And many investors therefore also fall into the pitfalls of investing because they are not well informed beforehand or are very eager to hear a certain return, or like timing, for example. Yes, the market has given me a good return and the outlook is not so good at the moment, so I take some money out of my investment account, or I invest in that one interesting investment with guaranteed returns from that one company, where it turned out that the one company could easily go bankrupt. And the list goes on and on. In this video, I'm going to reveal to you the secret on whether you can time the market by getting in at the right time or getting out at the right time. Because if you can do this, you can make a huge amount of money, right? Well, if you decide to invest, you don't do it with the plan to withdraw all your money tomorrow. This is the same as if you buy a house today and in 2 months think, yes, the housing market has gone up, so let's sell it again. And although this is of course possible, you still have the problem. Because what are you going to do with your money? Eventually, you'll need to reinvest it. Leaving your money liquid will ultimately result in a decline due to inflation and wealth tax. So, the person who says that saving is safe doesn't fully understand how the system works. Saving is safe for money you want to spend in the short term for unexpected expenses. Nothing more than that. Investing is much safer in the long run. What? What are you saying, Maurice? Well, let me explain it to you. Because in this chart, you see that if you had put $1 in your savings account in the 1900s, that same dollar would be worth $2 in 2023. And if you had invested, you would have received an average annual return of 6.7% over the whole period. Well, as everyone knows, guarantees usually only go so far. In other words, when you invest, guarantees aren't always worth much. So the question in this is, who gives you this guarantee when you invest? That's why I want to show you some data over the last few years. And of course, every period and every situation is different. But once you have data over a long period of time, of course, as an investor or as a shareholder, you can determine how likely it is to succeed. In short, you can make a better choice if you have more data, right? That's why I have a quick question for you. Do you think the economy will continue to grow and companies will make more profits over the long term? If the answer is yes, then you would agree with me that if you as a shareholder rise along with the value of the company, and therefore you are further rewarded in the form of dividends, right? And if your answer is no, then I think we have a bigger problem. Well, now let's dive into the stats that tell you more about whether you can predict the market or not.
Because a good thing to know is the following.
Here, you see a graph of the MSCI World Index of Europe over a period of 44 years from 1982 to 2023. Since 1972, there have been 11 years where you had ended in the minus in that particular year. What you also see is the following. To give you an answer when to get in the market, you want to delve into annual returns and intra-year decline. And this is where it gets interesting, because an annual return refers to a return that your investment makes over a full calendar year. And this return can of course be positive or negative. An intra-year decline refers to the largest drop from the highest point to the lowest point within that same calendar year in the meantime. Are you still there? Well, as a matter of fact, sometimes it may happen that you're significantly in the red during an investment year, but ultimately end up with a positive return in the stock market. For example, in the 1980s. Here you see a time when your portfolio fell minus 11%. And pay attention for a moment, because this is where it gets interesting, because by the end of the same year, you end up with a positive return of 13% in the plus. So, the market dropped by 11% at one point, but ultimately, by the end of that same year, you were up 13%. That means if you had panicked and exited, you likely would have missed out on a lot of return. Well, in 2008, the intermediate decline in that year was minus 48%. But here you ended the year still with a negative return of minus 41%.
And I understand that this is not so nice, right? And of course, as an investor, you would prefer to avoid this. But I will tell you the secret later why you don't want to exit the market in between. Alright, let's go back to the same data, because the red dots indicate the largest declines during that year.
And the gray bar shows the actual return you would have eventually made after that year.
And then in the end, you will probably say, yes, nice Maurice, but all I really care is about the final returns. But then I want to tell you it's kind of interesting to see what can happen in such a year in terms of movement. Because you see that the stock market often goes up and down and can be quite volatile in the same year.
Still, you see that most of the time the gray bar ended with a positive return. And here it gets interesting, so pay close attention, because history shows that stock prices can move sharply in the short term, but they predominantly recover positively over the long term. So the key question you can ask is, how often does the market close positively and how often does it close negatively?
Well, that's a good question, and I'm glad you're asking it, because with this chart I simply answer this question quite simply. Over a period from the years 1980 to 2023, it's a total of 44 years, the stock market has ended with a final positive return in 33 of the cases. That's 33 years.
This means that the data over a period of 44 years indicates that you would have made a positive return 75% of the time. So if you know that your portfolio is consistently rising 75% of the time, then the question of whether you should exit the market is no longer that difficult to answer, right?
So this also means that the market is down 25% of the time.
But, as you can also see here, the bubble markets, that is, the upward trends, are much longer and with many more upward outliers. I tell you more about this in a video where 80% of your returns come from, and the link of this video can be found below. Alright, the next graph is also interesting, so just a brief moment to focus your attention. Because when are the best trading days? The days when the market has risen the most in the past 44 years. In this graph, you can see that 12 out of the 20 best trading days occurred in the years following by negative returns. And what you also see is that 8 out of the 20 worst trading days occurred after positive years. In short, you can't predict the market, because after the period with the deepest declines, which you can't determine beforehand, you see strong market rallies that you don't want to miss. And because the market rises 75% of the time instead of falling, the chance is greater that if you exit the market, you'll miss out on a portion of that 75% rather than being afraid of going down 25% of the time. Plus, the longer the period you invest, say 10 years or longer, the smaller the chance of a negative return becomes. But you must remain invested throughout the entire period. Then, a graph where you can see that if you've been in a bear market in the S&P 500, and a bear market is a market where your portfolio declines by more than 25% in 1 year. What does the data typically look like in the following year? In other words, how quickly or how long does it take for you to recover? Then I have this last graph for you. In this graph, you can see the 12 months following a bear market period. You'll notice that only in 2001 and 2008 did you have a negative return in the following year. But in most years, where there was a decline of 25% or more, you actually achieved a 15% or more return the following year. So, don't sell when the market drops sharply out of emotion, but wait for the recovery. Sometimes it may take a while, but it often happens unexpectedly. And this recovery often comes with high peaks. So, the last question to you is, and this is also the question we started the video with, what if you can achieve 6 to 10% return, and you know that the risk, as you extend the duration, think 10 to 15 years or longer, that the risk is low? And this is evidenced by data from the past 44 years. Plus, you know the market goes up 75% of the time. And when the market goes up, it goes up longer and harder than the moment it goes down.
So is it wise to start today, or is it better to wait until next year or the year after? And if your answer to this question is today, and you are aware of the risk of the short and the long term, then my goal for this video is achieved. And you do understand my point that I want to make in this video with this data. Alright, in the next video I will explain whether it's better for you to do it yourself or if you are better off outsourcing your investments to a wealth manager. See you then.